Trump's new tax law, retirees can't afford to waste the next 4 years. Some ads may appear during the video. Your support allows this channel to keep sharing valuable retirement and investment insights for free. Let's dive in. Imagine for a moment that you have worked 40 years to build a 7-figure nest egg, only to realize that the rules of the game just changed while you were standing on the 18th green. Right now, there is a silent deadline approaching that most retirees are completely ignoring. According to recent IRS data, millions of Americans are currently sitting on a ticking tax time bomb in their traditional 401k and IRA accounts. And if you don't act within the next 4 years, the government could effectively become a 35 to 40% partner in your retirement savings. We are entering a unique window of opportunity under the new tax laws, a period where your decisions regarding capital allocation and liquidity management will determine whether you keep your wealth or watch it erode through avoidable tax exposure. The reality is that we are living through a massive shift in the Internal Revenue Code. For years, investors have been operating under the assumption that tax rates would eventually have to skyrocket to pay for national debt. But with the passage of the new legislative updates, the landscape has been redrawn. We aren't just looking at a simple extension of old policies. We are looking at a fundamental restructuring of how the wealthy and the retired are taxed in the United States. If you are between the ages of 55 to 75, the next 4 years are arguably the most critical period for your financial legacy. Why? Because the IRS has just adjusted more than 60 tax provisions, and for the first time in a generation, the window for aggressive tax optimization is wide open, but it is not a window that will stay open forever. Many people think they can just wait until they are 73 or 75 to start thinking about their required minimum distributions, or RMDs. That is a dangerous mistake. By the time you reach that age, your account balances may have compounded to a point where your mandatory withdrawals push you into the highest possible tax brackets, triggering the net investment income tax and significantly increasing your Medicare Part B and Part D premiums through IRMAA surcharges. This isn't just about paying a little more in taxes, it is about a systemic drain on your purchasing power. We are seeing a new U.S.-centric foundation for wealth building where the primary goal is no longer just accumulation, but rather strategic capital allocation to ensure that your lifetime of work isn't liquidated by the state. While this script focuses on the high-volume U.S. market, it is worth noting for our international viewers in the UK, Canada, and Australia that this trend of tax-centric retirement planning is a global phenomenon. Whether you are dealing with the pension lifetime allowance shifts in the UK or the registered retirement savings plan rules in Canada, the principle remains the same. The most successful investors globally are those who prioritize tax efficiency over raw returns. So, how do you navigate this new era of tax law without wasting the precious time you have left? We have to look at this through the lens of institutional-grade wealth management. You need a framework that treats your personal balance sheet with the same rigor that a CEO treats a corporate treasury. We're going to break this down into 4 core pillars of the new tax strategy: the senior bonus optimization, the Roth conversion window, the asset-based lending pivot, and the estate tax exclusion shield. The first pillar is the newly enacted senior bonus deduction. This is a massive shift that many retirees are overlooking. For the upcoming tax year, the standard deduction has jumped significantly for married couples filing jointly. But under the new laws, there is now an additional senior bonus for individuals or couples who are 65 or older. If you and your spouse are both over 65, your total standard deduction could be substantially higher when you combine the base amount, the existing age-based deduction, and this new bonus. This isn't just a feel-good tax break. It changes the math on your entire withdrawal strategy. If you are in the $150,000 to $250,000 income range, this deduction begins to phase out, so you have to be incredibly precise with your income targeting. Are you accidentally pushing your modified adjusted gross income just $1 over a threshold that costs you thousands in lost deductions? This is where professional tax optimization becomes a high ROI activity. You need to look at your income sources, from Social Security to private annuities, and ensure you are hitting that sweet spot where you maximize these new deductions while they are available. The second pillar is the Roth conversion window. This is perhaps the most powerful tool for anyone with a significant balance in a traditional 401k or IRA. Currently, the federal tax brackets are at historic lows. The 12, 22, and 24% brackets cover a vast majority of the income earned by retirees and professionals. For example, a married couple can have a taxable income of up to roughly $400,000 and still stay within the 24% bracket. The strategy here is what institutional investors call bracket topping. You look at your current income and fill up your current tax bracket by converting a portion of your traditional IRA into a Roth IRA. You pay the taxes now at these lower rates, and in exchange, that money grows tax-free for the rest of your life. More importantly, it is not subject to RMDs. If you wait until tax rates inevitably rise in the future, or if you wait until your RMDs are forced upon you, you might find yourself paying 32 or 35% on that same money. By executing a series of partial Roth conversions over the next 4 years, you are essentially buying out the government's share of your retirement account at a discount. Third, we have to talk about liquidity management and asset-based lending. For business owners and high-net-worth investors, the new tax law has introduced interesting dynamics for those who need cash but don't want to trigger a taxable event. Selling highly appreciated stocks or real estate to fund a lifestyle or a new business venture can lead to a massive capital gains tax bill. However, in the current environment of stabilized interest rates and corporate earnings growth, many savvy investors are turning to securities-backed lines of credit or asset-based lending. Instead of selling an asset and paying 20% in capital gains plus the 3.8% net investment income tax, you can borrow against the portfolio. This provides immediate liquidity without the tax bite. Furthermore, the new law has made certain interest deductions more attractive for business use. If you are using that liquidity for a pass-through entity, like an S-Corp or an LLC, you can often leverage the expanded Section 199A deduction, which has been made permanent and even expanded for certain sectors. This is institutional-level capital allocation, using debt strategically to preserve your equity and minimize your tax footprint. The fourth pillar is the estate tax exclusion shield. This is where the next 4 years are truly use it or lose it. The estate tax exclusion has been raised to a staggering level for individuals and married couples. This is a massive increase from where we were just a few years ago. If your estate is anywhere near these numbers, you have a golden opportunity to move assets out of your taxable estate and into irrevocable trusts or other wealth transfer vehicles. By doing this now, you lock in the higher exemption. If the political winds shift in 4 years and the exemption is slashed back, those who acted will have successfully shielded millions from a 40% federal estate tax. This is the definition of estate planning. It's not about what happens when you pass away. It's about the strategic moves you make while you are still here to ensure your heirs aren't left with a massive tax liability. I know what some of you are thinking. Isn't this just for the ultra-wealthy? Or what if the law changes again next year? These are valid concerns. But the beauty of the current legislation is that much of it provides a clear 4-year runway. Even if you aren't a multimillionaire, the principles of tax diversification apply to you. Having a mix of taxable, tax-deferred, and tax-exempt accounts gives you the optionality to navigate whatever the IRS throws at you in the future. If tax rates go up, you pull from your Roth. If they stay low, you might pull from your traditional IRA. Without that flexibility, you are at the mercy of the current administration's whims. Another common objection is that the cost of doing these conversions or setting up these trusts is too high. But you have to compare the cost of a professional tax strategy against the cost of doing nothing. If a $100,000 Roth conversion today saves you $30,000 in future taxes and prevents a $5,000 annual increase in your Medicare premiums, the return on that decision is astronomical. You have to view tax planning as a high-yield investment, not just an administrative burden. So, what are the specific, implementable next steps you should take right now? First, perform a tax bracket audit. Look at your projected income for the current year and identify exactly how much room you have left in your current tax bracket. If you are in the 22% bracket and you have $50,000 of room before hitting the 24% mark, that is your target for a Roth conversion or a capital gains harvest. Second, reevaluate your RMD schedule. Even if you are only 60, run the math on what your RMDs will look like at age 75. Use a conservative 6 to 7% growth rate. If that number looks like it will push you into a higher bracket than you are in today, you need to start de-risking that tax liability immediately through annual conversions. Third, explore tax loss harvesting and gain harvesting. With the stock market reaching new highs, you likely have significant unrealized gains. Under the new rules, it might actually make sense to harvest some gains now while the capital gains rates are favorable, especially if you can offset them with any carried over losses. This resets your cost basis and reduces your future tax burden. Fourth, consult with a fiduciary who understands the intersection of estate law and the new legislative provisions. This isn't the time for a set-it-and-forget-it approach. You need someone who can model out the impact of the senior bonus, the new AMT exemption phase-outs, and the expanded estate limits on your specific portfolio. The next 4 years will go by faster than you think. In the world of finance, time is your greatest ally, but it can also be your most unforgiving enemy. Those who spent the last few years waiting for certainty missed out on some of the greatest wealth-building opportunities in history. Don't make that mistake again. The rules are clear, the brackets are set, and the deductions are waiting. The only thing missing is your action. We are entering a period where the difference between a comfortable retirement and a struggling one isn't just about how much you saved, but how much you were allowed to keep. By focusing on liquidity management, capital allocation, and tax optimization, you are taking control of your financial destiny. You are ensuring that your legacy is defined by your foresight, not by the government's appetite for your hard-earned assets. If you found this deep dive into the new tax landscape helpful, make sure to subscribe so you don't miss our regular updates on wealth management and retirement strategy. We are constantly monitoring the IRS for fresh updates and will be uploading new videos on these subjects regularly to keep you ahead of the curve. Also, please click the thumbs up button to give us a like as a thank you for this valuable content. It really helps us reach more people who need this information. I would love to hear from you in the comments. Which of these 4 pillars, the senior bonus, Roth conversions, asset-based lending, or the estate shield, is most relevant to your current situation? Do you have questions about how the new phase-outs might affect your specific income level? Drop a comment below and let's start a conversation. Please remember, I am not your financial advisor. The information provided in this video is for educational purposes only and does not constitute professional financial, tax, or legal advice. Every person's financial situation is unique, and you should always seek the counsel of a qualified professional, such as a CPA or a certified financial planner, before making any significant changes to your investment or tax strategy. Thank you for watching, and remember, the next 4 years are yours to win or lose. Make them count.